Hey everybody, Marty Missouri here. It is the 25th of March 2023 with your weekly economic update. That part's going to be pretty quick, and then I'm going to throw a bunch of market stuff at you. Just completed the entire macro exercise that we do each week or weekend. And so much that I'd love to share, but I would put you to sleep if I even tried to go through half of it. So each week, I kind of pick and choose what I think will be interesting, hopefully telling, informative, insightful relative to the world we live in today from an investment perspective. So we'll just do the usual at first, and then I'm going to throw some things at you that I normally don't, just to kind of mix it up a little bit this week. So in front of you is the PWA index. We went back up 2 points to a negative 31. Very, very much in the territory that says recession odds favor expansion odds going forward. Just a few inputs from our index. Thought I'd start with a positive. Truck tonnage actually continues to trend higher in the face of otherwise somewhat recessionary conditions, particularly in the kinds of things that you cart around by truck. So interesting, but we show the data as it is and we score it accordingly, and that is a net positive in our index currently. The Chicago Fed National Activity Index dipped back into the red over the past month. It's an index within our index. It has 85 inputs. Currently 38 are positive, 47 read negative. Another positive, in a sense, is the U.S. Citigroup Economic Surprise Index. Doesn't mean the economy is growing rapidly in expansion mode. The fact that it's up 61, which is a very nice score. What it says is that the economic data is coming in better than economists had anticipated. As you can see, that was happening right here during the deep recession, very, very short recession in 2020. You can see it was positive during this recession, which was the great financial crisis that was mostly in 2008. So as you can see, it doesn't mean that we're out of recession, doesn't mean that we're not in recession, just means that the data has come in better than what economists had expected. Monthly durable goods data came out last week. We like to look at the core, which is ex-transportation. Didn't budge month over month, so basically no change. 1.7%, call it, on a year-over-year basis. Headline durable goods continue to decline. Lastly, with regard to our PWA index, once again, the staples to discretionary stock ratio, it's still negative on the year by 10.7%. However, trending higher for the past 3 weeks or so. That would be considered a somewhat negative signal relative to the state of the economy. Okay, so let's get into some other stuff. First of all, on a weekly basis, we take a good long look at market breadth. In front of you is the S&P 500. White line is the S&P 500 index that we're all familiar with. The green line is the S&P 500 equal weight index. Now, you remember in my video a day or so ago, I showed you the top holdings in the S&P, and the S&P is cap weighted, so the bigger companies have a bigger representation in the index, whereas the equal weight index just takes all of its 500 plus components and gives them equal weight. So the green line, one might say, is a better reflection of the overall stock market. The white line represents something that's very concentrated. I think tech is still like 25% of the index. So this would be considered lousy breadth, where the cap weighted index is going up and the equal weight index, right, everything equally positioned, is actually going down. That says that the overall state of the market is not all that healthy, and the S&P 500 index is not really indicative of a good quality market to be investing into right now. Another breadth indicator is the advanced decline line. So the S&P up here in yellow, noisy, messy looking chart, I apologize. The blue line is the advanced decline line, right? So this is cumulative. So when there's more advancers relative to decliners, the line goes up. When there's more decliners relative to advancers, the line goes down. Historically, this has been a really good indicator for us. Here we have the S&P rising, and we have breadth, like with the equal weight, not confirming the upturn in the S&P. The number of members trading above their 50-day moving average, this has been a very important one to look at. While the S&P has risen here of late, this thing has fallen like a stone. Only 23% of the index is trading above its 50-day moving average. That is really, really ugly breadth, clearly. And then the NASDAQ composite, remember I featured that here a day or so ago also, and said that it's holding up against, we think, some pretty heavy overhead resistance. And if the NASDAQ were to give up the ghost here, it'd be real ugly for the broader market as well. And so here, we do have our, our classic bearish rising wedge pattern, but the AD line, the advanced decline line for the NASDAQ composite index, is really ugly relative to price. So that's a very bearish signal from a breadth standpoint as well. And now just looking at sectors overall. So the S&P is up 3+% on a year-to-date basis. And guess what? Only 3 sectors, and we have 11 sectors featured here, are actually in the positive, and positive in a really big way. So this speaks to the concentration of the index and the pull of just a few stocks or just a few sectors. So the communication sector is up 18.45% year to date. Tech is up 17.5%. And consumer discretionary is up 9.6%. And again, you can see that one coming off the boil here, which is reflected in that Staples discretionary ratio I like to show you. And then all the rest of them are reading negative. You have materials down 1.1%. You have industrials down 1.3%. You have consumer staples still down 2.2%. You have REITs down 3.5%. You have healthcare down 6.4%. Utilities down 6.8%. You've got financials down a bunch here with the banking issues of late, 9.5%, call it. And then you've got energy coming off of last year's massive gains, down 11%. And so you've got both your economically sensitive stuff going down, you have economically defensive stuff going down, and then up here you have your tech and your communications really just, going crazy to the upside, so to speak. Now, this, to some degree, actually does speak to weakness in the economy or the perception that weakness is coming, particularly when we talk about communications and technology stocks. These are what are considered long duration stocks. Now, we typically think of long duration in the bond market and say the treasury bond market. We want to own long-term treasuries right now because we think the economy is going to slow down and interest rates are going to come down. So if interest rates are going to come down, the longer the duration, the better the capital appreciation is going to be of that investment if you're right and interest rates are going to come down. Long duration stocks will be stocks that are traded based on long-term earnings prospects. And when you do valuations on stocks, you discount them to current interest rates. So if somebody is putting a present value of future earnings on a company, let's say as one metric, well, the discount rate, if it comes down, is going to make that look more attractive. So the longer the earnings horizon that we're talking about or that we're betting on, the more important lower interest rates are going to be. So traders will see that. They'll say interest rates are coming down by tech, by communications, because they're long duration stocks. Okay, that's fine. And the market's trading up, particularly where the market is concentrated, speaking of the S&P 500, on the prospects for interest rates to come down. But if interest rates come down the way we think they're going to be coming down because we're in a recession. And we're in recession, the companies that now seem to be just obsessed with their stock prices and managing their earnings, tech especially, laying off people, as if we're already in recession, right, in a big way. Well, what do they see? Well, they see an earnings recession coming. And as one of my favorite macro strategists says, CEOs today have become nothing more than shepherds of their stock price, the way their compensation packages are handled. So you're going to see a reduction in corporate spending. I think investors who are bidding up these prices are probably putting the cart before the horse, and it's more likely that what this reflects is going to be a drag and a pull on this as opposed to this being a pull upward on these. Could meet somewhere in the middle, but again, this is not the look of a healthy market. So here is our daily one-year chart of the S&P 500 index. And, we had this bear flag. I thought that was a really classic bear flag, and it played out perfectly right at that 3,800 where I said when we were back up in here that we'd probably see some pretty good buying. Got all of that. Right now we do have a buy signal on the MACD, which would be a positive in terms of something the bulls could get very excited about. We think there is just massive overhead resistance, and like I said the other day, there's virtually no way that our momentum indicators right in here are going to give you the all clear above that, and that's probably going to be another bull trap, is how it looks to us technically. Although right now in the near term, at least on the daily, not so bad. On the hourly, now this is a 60-day, 60-minute chart. But now when we really drill down short term, man, oh man, that looks like a pretty good bear flag to me. And if that's the case, we could come right back and test these levels right in here, about 3850-ish. And then again, that 3,800. We could bounce off that a few times before we break it if indeed we're right and that we ultimately go lower. Once again, the Qs, the ETF that tracks the NASDAQ 100 index, showed you this the other day. This was Friday's candle, still right there, just kind of bumping up against that resistance. This doesn't look as good as the S&P 500 on the daily chart, this from a upside resistance and from a momentum perspective. Now, lastly, since I pulled these charts up, I'm just going to keep going here. GLD, which represents gold. It's the gold ETF. It's the one we use in our portfolios. It's a not small position for us, I'll tell you. And we do like it a lot long term. Folks who've been reading the blogs, on the last couple of year-end letters, I've really drilled down on our long-term view of how the world's going to have to be in some respects going forward. The U.S. overall setup really reminds us of the 1940s backdrop, one where you're going to have some inflation, moving to the capital regime from the labor-friendly regime. We've done all that discussion herein. I'm sure we'll do more of it as we go forward. But we have structural inflationary pressures that go on for quite a few years going forward, if not decades. And we have this massive debt backdrop. So we don't have a late 70s, early 80s where the U.S. was 30% debt to GDP and Paul Volcker could be aggressive without really necessarily destroying anything terribly. Whereas today we have 130% debt to GDP, and as we're already learning, it just can't go crazy to the upside with interest rates. And in the 40s, what the Fed did is they implemented a strategy called yield curve control. Out the curve, they kept treasury rates at 2.5%. And they allowed inflation to run hotter than that. So we had negative real interest rates. That is the ideal setup for gold. So longer term, we think gold will be in our portfolio. Shorter term, technically, not looking so great. We've had a really nice run. We're up over 8% in that position this year. But we have, if I stretch that out, we're going to have what is your classic rising wedge pattern. And right now we have a new high, but we do not have confirmation. In fact, the RSI is rolling over from an overbought position. And the MACD looks like it could at some point here. So longer term, very bullish gold. Near term is not something we would add to right here. Here was the opposite of that. Right here, we had a nice falling wedge, and we had nice bullish divergences that really set us up for this really nice run in here. So, it makes sense. Nothing goes up forever, that there may be some give back in here. I could actually make a bullish case just based on what's going on in the world that may absolutely overcome the technicals, but from a pure technical perspective, not a great look, at least on the daily chart. I also pulled up DBA, another big position for us. This is a ag ETF that we bought a little over 2 years ago. Over that time period, we're up very nicely. Certainly a good thing to own compared to what the stock market's done. But you can see here for, going on 9 months or so, just a massive consolidation. Swing traders have probably done okay in here playing something like a DBA. Now, where we're sitting today is kind of the opposite look of what I just showed you with gold, right? We actually have a nice falling wedge, right? We have getting close to a buy signal from below zero on the MACD, and that would be a positive divergence here. That's not a lower low on the RSI, kind of coming off of that. Here's a falling wedge that we identified back in here. Got the buy signal, got a really nice pop, but you can see it looked kind of like this. A little better maybe on the RSI heading into that pop. So clients, here you have gold, which is looking a little short-term negative. We have ag, which is looking short-term positive. I will give this advice to all of you, and that is be very, very, very diversified in your portfolios. We talk mostly about stocks here on the blog because that's what people want to talk about. That's what they think about. That's what they associate firms like ours with. But that's not really how to invest smartly, we think, long-term. There's a whole world of opportunities, a lot of them outside the U.S. in the equity space, but a lot of them just asset class to asset class. So a good, smart, long-term portfolio is going to be diversified across asset classes, particularly at times like these. Anyway, for what it's worth, again, I wanted to mix it up a little bit today. There's DBA. And then lastly, just zeroing in on the ag complex, wheat in particular looks technically compelling right here. That is pretty classic. You've got great positive divergences here and a falling wedge pattern. So pretty compelling technical setup on a commodity that's been beaten up pretty good, down 13%. This is the wheat spot price. So anybody watching this who's not a client, if for some reason you do your own work or you talk to your advisors, you're not taking advice from me, but you can trade wheat in the futures markets. There are some wheat ETFs that move virtually right with the price that can be traded as well. But again, I'll say it again and again and again. This is not investment advice, particularly to anybody who's not a client. If you are a client, of course, we do it for you. But anyway, hope, folks, this is interesting. I hope at some level it's helpful. And I hope you guys have an awesome rest of the weekend. Thank you, as always, for watching and listening. Talk to you again soon. Bye-bye.